how do we think about macro? I always use this analogy, right? I mean, every fund manager or analyst or anyone who invests in the market talks about, I want to invest in good companies. And good companies are defined by the P&L in the balance sheet of the company that you look at. Very similarly, macro to us is the P&L and balance sheet of the country. So to put it in very simple terms, there is a revenue for the country and there is an expense that the country spends on. Now, most of your revenues are going to come from three components, which is service tax, corporate tax, and income tax. Service tax is what transitioned to GST in 2017. So back in 2010, corporate tax used to be 40% of the revenue for the government. Service tax used to be 10, and income tax used to be 20. Come fast forward in 2025. Today's service tax, which is GST, is right now close to 30%. So not only has the magnitude gone up, the contribution has gone up. Corporate tax has gone down from 40 to 28, and income tax has gone up. So the simplest way to think about corporate tax is if EPS of corporate India goes up, corporate tax should go up. So then why is the contribution of corporate tax gone down? Is primarily because in 19, we cut our corporate tax from 35 to 25. That's a 33% cut. So you will see a drop from a contribution perspective. So now that I have set the context, it's an important thing that to go slightly deeper into what is called as income tax. Now, income tax is normally the people like you and me, what we pay as tax every year. Now, there is a small component of that, which is market linked, which is the sum total of LTCG, STCG, and STT put together. Now, India in the last 20 years, pre-COVID, this market linked tax as a percentage of the total gross tax revenue used to be between half to 1.1% over the last 20 years. Now, post-COVID, obviously through equity participation, depth of the markets and equity rally, as of FY25, if you look at this chart on the right, today it's at 5.2% of the total gross tax revenue. Now, what's the implication of this? I'll explain to you on the next slide. Now, this slide on the left explains or breaks down the total net tax revenue, which is what the government earns. As you can see, year-on-year numbers will be volatile because it could be a low base. For example, 21 to 24, that CAGR would be around 18.5 to 19%. Pre-COVID, it was closer to 5 to 6%. But overall, over the last 15 years, it's grown between 8 to 9%. So when the government does its budget and it guides you for next year, it assumes that the next year, unless barring any untoward event, their tax revenue will grow by that usual 8 to 9%, which is what they have done in the budget for 25-26 also. The implication of that is the market linked tax revenue implicitly they are assuming will grow, which is the biggest risk, because if the market falls, like what we've seen in the last 6 months, a large part of your LTCG and STCG will go away. So what the government is budgeting implicitly without telling you this is roughly your market linked tax revenue will be 5.6 to 5.7% of your gross tax revenue for FY25-26. The way we see this number is going to be closer to 3%. So there is going to be a 3% revenue deficit that you will be hit with this year. I think it will become clearer as you go into subsequent quarters. What is the impact of that? So what we covered is the revenue side. Now we'll go into the expense side. One of the most important parts where the government spends is CAPEX. As most of you are aware, between FY20 and 24, our CAPEX grew by almost 26%, which is what this chart on the right shows you. So the growth was robust. So the government basically came and said in FY26, they are guiding for a fiscal deficit to drop to 4.4%. So if your fiscal deficit has to drop, which means effectively you're generating higher cash flow in order to cut down the debt, then you have to cut down expense. Now, they have already guided for your CAPEX only to grow at 10% for 25-26. But because the revenue is at risk, this number can drop even further. So the sum total of all these four charts put together, if I was to give you three takeaways, they are as follows. The risk on the revenue side is the government may not make as much as revenues as what they have budgeted for. The implication for that is capex spends should be lower than what they are budgeting for, as a result of which, for the next 4 to 5 quarters, you will see our portfolio underweight capex. Right? So this is broadly what I wanted to communicate. So if you look at our portfolio from October to January, you would have seen roughly 20% of sales predominantly coming from these themes. So because many of them have written to me saying, why has the churn increased in the last 3.5 months? The churn increased because I had to reposition risk. We had to cut down capex from October onwards to January, and that was reallocated somewhere else. Where was it? I'll cover it at a sectoral level shortly.